All right, folks, gather around. Today we're diving into the thrilling world of accounting disclosure. Think of it like this. Remember that time you tried to sneak an extra cookie before dinner and your mom caught you? That's disclosure, except instead of cookies, it's financial information. And instead of your mom, it's the Securities and Exchange Commission. And instead of getting grounded, you could go to jail. Just kidding. Mostly. We're talking about the rules and regulations that keep companies honest and transparent. So buckle up, Buttercup, because we're about to embark on a wild ride through the fascinating world of accounting disclosure. Section 2. What is accounting disclosure? Spilling the financial tea. In the simplest terms, accounting disclosure is all about companies coming clean about their financial dealings. Think of it as a giant confessional booth for corporations, except instead of a priest, they're confessing to investors, regulators, and anyone else who cares to listen. It's about providing a clear and accurate picture of a company's financial health. This includes everything from their revenues and expenses to their assets and liabilities. Why all the fuss? Well, for starters, it allows investors to make informed decisions. After all, you wouldn't buy a used car without looking under the hood, would you? The same principle applies to investing in a company. Disclosure provides the financial equivalent of a Carfax report, giving investors the information they need to decide whether or not to buy, sell, or hold. Think of it as the financial equivalent of truth serum. It might not always be pretty, but it's always necessary. Section 3. A brief history of disclosure. From Wall Street crash to transparency. To understand the importance of disclosure, we need to take a trip down memory lane, exploring the pivotal moments that shaped the financial world as we know it today. Specifically, we're going back to the Roaring '20s, a time of flapper dresses, jazz music, and rampant financial speculation. It was an era of unprecedented economic growth and exuberance. Unfortunately, the party came to a crashing halt in 1929 with the stock market crash, which plunged the world into the Great Depression. This catastrophic event exposed the fragility of the financial system. What does this have to do with accounting disclosure? Well, it turns out that one of the contributing factors to the crash was a lack of transparency in the financial markets. Investors were often kept in the dark about the true financial health of companies. Companies were basically free to make whatever claims they wanted about their financial performance with little to no oversight or regulation. This lack of accountability led to widespread misinformation and ultimately financial disaster. Enter the Securities Act of 1933 and the Securities Exchange Act of 1934. These landmark legislations were designed to restore investor confidence and bring order to the chaotic financial markets. These acts established the Securities and Exchange Commission, SEC, which is responsible for enforcing federal securities laws and regulating the securities industry. The SEC's mission was to protect investors and maintain fair, orderly, and efficient markets. Fast forward a few decades, and we have the Sarbanes-Oxley Act of 2002, also known as SOX. This act introduced major changes to the regulation of financial practice and corporate governance. This act was passed in response to a series of high-profile accounting scandals, such as Enron and WorldCom, which shook investor confidence to its core. These scandals highlighted the need for stricter regulatory measures and greater transparency. So there you have it, a brief history of accounting disclosure. From the chaos of the 1929 crash to the stringent regulations of today, transparency has become a cornerstone of financial stability and investor trust. Section 4. Why disclosure matters. Leveling the playing field. Now you might be thinking, okay, so disclosure is important for investors, but what about the rest of us? How does it benefit the average person? Well, the truth is that disclosure affects all of us, even if we don't realize it. For starters, disclosure helps to level the playing field. When companies are required to disclose their financial information, it creates a more transparent and fair market for everyone. Small investors have access to the same information as big institutional investors, which helps to prevent insider trading and other shady practices. But it's not just about fairness in the markets. Disclosure also promotes accountability and good governance. When companies know that their financial dealings are open to public scrutiny, they're more likely to act in an ethical and responsible manner. In short, disclosure is essential for a well-functioning economy and a fair and transparent society. Section 5. Types of disclosure. Let's get down to brass tacks forms. Now that we understand why disclosure is so important, let's talk about the different types of disclosure that companies are required to make. These disclosures are essential for maintaining transparency and trust in the financial markets. Don't worry, I'll try to keep it as painless as possible. We'll break it down step by step so you can grasp the essentials without feeling overwhelmed. First up, we have the big kahuna of financial reporting, the annual report, also known as the 10K. This document is a cornerstone of corporate transparency. This bad boy is a comprehensive overview of a company's financial performance over the past year. It's not just a summary, it's an in-depth look at the company's operations and financial health. It includes everything from the company's history and business strategy to its financial statements and risk factors. This is where you get the full picture of what the company has been up to. Think of it as the company's autobiography. Except instead of juicy gossip, it's full of numbers and charts. It's a narrative told through financial data. Next, we have the quarterly report, or 10Q, which is basically a condensed version of the annual report. It's like getting quarterly updates on the company's progress. It provides an update on the company's financial performance for the past quarter, and is a good way for investors to track the company's progress throughout the year. These reports help investors stay informed and make timely decisions. But wait, there's more. The world of financial disclosure doesn't stop at annual and quarterly reports. Companies are also required to file other types of disclosure documents, such as earnings releases, proxy statements, and prospectuses. Each of these documents serves a specific purpose and provides different insights. The important thing is to be aware of the information that's out there and to use it to make informed decisions. By understanding these documents, you can better navigate the financial landscape. After all, knowledge is power, especially when it comes to your money. The more you know, the better equipped you are to make smart financial choices. Section 6. Real-world examples. Because nobody likes a shady balance sheet. Alright folks, let's bring this down to earth with some real-world examples of disclosure in action. These examples will help you understand the critical importance of transparency in financial reporting, because nothing makes a concept more relatable than seeing it play out in the real world, right? When you see the consequences of poor disclosure, it really hits home. Remember Enron? Of course you do. It's a textbook example of what can go wrong when companies aren't transparent. It was the biggest accounting scandal of the 21st century, and it all came crashing down because of a lack of disclosure. The fallout was massive, affecting thousands of employees and investors. Enron was cooking the books, hiding billions of dollars in debt off their balance sheet. They used complex financial structures to deceive investors and regulators. They were basically running a financial house of cards, and it all came crashing down when their shady dealings were exposed. The impact was felt across the entire financial industry. Then there's WorldCom, another poster child for bad corporate governance. Their scandal was another wake-up call for the business world. They were caught inflating their revenues by billions of dollars, making their financial performance look much better than it actually was. This deception led to one of the largest bankruptcies in history. Again, a lack of transparency and disclosure was a major contributing factor to their downfall. These examples show how critical it is to be honest and open in financial reporting. But it's not all doom and gloom, there are success stories too. There are plenty of companies out there that are committed to transparency and disclosure. These companies understand that honesty builds trust and long-term success. The point is, disclosure matters. It's the foundation of trust in the financial world, and it's something we should all strive for. Section 7. Conclusion: the future of disclosure. Transparency is key. So, there you have it, folks. A crash course in accounting disclosure. We've covered a lot of ground, from the history of disclosure to the different types of disclosure that companies are required to make. But the most important takeaway is this: disclosure matters. In today's interconnected world, transparency is more important than ever. Investors, regulators, and the public are demanding greater accountability from the companies they do business with. And companies are realizing that transparency is not just good for business, it's the right thing to do. So the next time you hear the term accounting disclosure, don't shy away from it. Embrace it.